Capital Flows panel, which each year focuses on inflows and outflows of capital around the world into and out of the U.S., both from a debt and equity perspective. We endeavor to cover both the public and the private markets each year. This year is no exception. We're joined today by Julia Butler, who's a Managing Director at KKR and CEO of the KKR Real Estate Select Trust, Inc., which is their registered REIT product. It's part of the $80 billion real estate assets under management that KKR has. It focuses on the investment side in both equity and debt. We have Tim Mackey, who's the Chief Investment Officer at LoanCore. LoanCore is a private real estate credit business. They've funded over $30 billion in 945 deals since 2008. Tim has his MBA from Columbia. Jennifer Dumas Hall is the Senior Managing Director at Rockpoint, where she focuses on capital raising in the private markets. Rockpoint, also $80 billion in AUM, 503 deals over the last 30 years. And stitching all this together is Jarrett Vitulli, who's the Senior Managing Director at Evercore, where he leads the real estate advisory practice, and they cover both private and public markets, debt and equity as well. So with that, Jarrett, I will turn it over to you. Thank you.
Thank you, John. And I just want to make sure that this will work. It will. Perfect. So I was spending some time trying to think about how we would actually get this started. And there were a couple of phrases that I heard at the end of last year. One I didn't love. The second one I actually liked. And the two phrases were survive to 25. And I'm a bit more of an optimist. And so I enjoyed thrive in 25. So with that, just to open it up, can you just describe, and we can go down the row, but just investor sentiment today?
Well, first of all, I went to undergrad at the University of Michigan, and Sam Zell, as most of you know, many of you know, said, stay alive to 95. And that was the original version of that. I'm not sure thrive in 25 is going to work, to be honest, based on the sentiment I'm observing. Maybe thrive by 35, and I'm not always negative, but maybe that's why I'm a debt guy now. I think, first of all, the things driving debt right now is there's a log jam, right? The dam hasn't quite broken yet, and it hasn't broken because we don't know what cap rates are. We don't know how to value things. There's transactions getting done. I think they're getting done by some of the best operators and owners. But there's a dearth of transactions overall. There's tons of money ready to invest. We just don't know at what level. We just need some realization of pricing, I think. And the banks hold about 50% of our $6 trillion of debt in the United States. They're under extreme regulatory pressure. So there will be some transactions forced out of the banks. The private and public debt funds are lending. We lent about $1 billion between June and December of 24. We just sold a CLO last month, public. It flew off the shelves. The investor demand for bonds backed by real estate securities is as high as it's ever been. Our lower bonds in particular were 6 times oversubscribed. A typical run rate, 2018 to 23, was about 1.5 to 3 times oversubscribed. So there's money out there. We just need more real estate transactions. I'll save some more for later and let you answer.
Sure. So I have the benefit of talking to a number of LPs. I predominantly cover North America, but at the same time, we have colleagues that are covering, the global markets. So I think the good news is that we're no longer talking about a denominator effect, which is positive. However, the bad thing is kind of taking some of Tim's comments, it's liquidity. It's the lack of distributions, which translates obviously to valuations and transaction activity. That doesn't mean we're not talking about interest rates and inflation, but I would say that, again, liquidity, J-curve, those are things that are top of mind.
That makes sense because I think the stats that we have, and we don't have the slide on this one, but transaction volume's been off roughly 70% going on 3 years, and that's the number one thing that we hear from LPs as they're thinking about investing new funds. And obviously when we meet with sponsors, clearly that's the number one thing on their mind, particularly if they're fundraising. And Julia, I'll give you a few moments to comment as well.
Look, I think I'm going to play the optimist today.
Yes.
Because I think a couple of things have to happen for transaction volumes to increase again. But I think the recipe is almost here. As rates stabilize and as more people are willing to lean into pricing, and as core capital comes back, which we are starting to see,
Yep.
there's going to be a momentum effect. And so I think we're at a good time. Like, supply is coming off, assets are trading below replacement cost. You have a moment here to take advantage of a good macro. And so I'm gonna be optimistic and say that by the end of this year, things are going to be rolling in a really positive way.
Great. Well, you hit on a buzzword there, which was buying below replacement cost. And so maybe if I could ask you to just spend some time making the case for equity today, because I feel like, and Tim, you can maybe take the opposite side. The last couple of years, there's been such a transition into debt, from 22, 23, 24, and it made sense at the time. And so I'm just trying to get the sense and sort of talk through, like, where is the best relative value today?
I'll just follow up on one thing. 'Cause one of the biggest signals that we're following is on the credit market side, where debt capital is trading. Just the last 6 weeks, spreads have compressed dramatically. And CMBS and insurance capital has flowed in a way we haven't seen in a long time. Last year, I think SASB volumes were up 150% on the prior year. And just this first 6 weeks of this year, we're at record volumes. And spreads are back at record lows relative to even pre-pandemic spreads. So I think generally that's a signal that people are going to start pivoting back into equity because the cost of capital's coming down. And I think, last year we did a lot on the equity side. I think we closed on just under $13 billion of transactions. And we were leaning in. There hadn't been price discovery. And we were leaning in because we were able to buy really high quality assets at 20 to 30% discounts to replacement costs. And when you're able to do that, especially because we know construction costs never go down, over 20 years, they've never gone down, you're probably buying at a good time because supply is going to be muted, and therefore we're probably entering a time of outsized rent growth. That was our thesis, at least.
Well, listen, I can be positive too, okay? I've recently invested in several $100 million of equity positions. Now, they started out as debt 4 years ago. But I own them. And one thing Julia said a moment ago, which I really want to hit on, which I believe everything you said, but one thing I want to highlight was when rates stabilize. 30 years ago, people barely knew what a 401k were, and then CNBC came out, and everyone follows now rates, 401k, stock market, S&P, every day. Every real estate guy I know is now an interest rate trader. And, be careful. I really like what Mark Holliday said. If you can't make money at 4.20 interest rate, maybe you shouldn't be in the business. Because the rates aren't historically horrible, but we do need them to stabilize. Because when they bounce around from 378 to 478, amidst a lot of uncertainty, if I was a real estate owner, I'm not sure I want to lock in a 10-year fixed rate loan until I realize where that's going to land. So, but I think we're getting there. Where our range has been a little tighter in the last couple months. And so I think we're around 430 right now on the 10-year. So I think that, pardon me, I think that's key, the stability, and I think the number's not that bad. And we're open for business as a lender for fixed and floating.
Yeah, that absolutely makes sense because volatility will kill all deals. And I do think I would agree that I'd say back half of last year, first part of this year, we generally have seen more bidders bid through some interest rate volatility, where I think in 22, 23, people just went pencils down every time like the rate had a dramatic move. So not to be depressing, because I did start and say I was more of an optimist, but we'll flip to the first slide, and we'll just talk about fundraising for a minute, because I know we have a lot of general partners in here focused on raising capital. I think what you can see, it's pretty evident, capital raising has declined roughly 70%, off of its peak. I think we're around 130 billion for 24. The number of funds in the market is at record levels, and the average time to close a fund is essentially ballooned to 2 years. And so I guess my question is, maybe to you, Jennifer, if 25 will be a better year for fundraising, and if it's not, what do you think the three reasons will be that it won't be?
So I will say that I do think it's going to be better. Like if you look at a lot of the pacing plans for pension plans are coming out right now, or they've been coming out over the past, I would say, 60 days, and they're healthier than they were in 2024. So that is a good news. I think that they're not back to normal. They're not at the normalized levels, and I'm not sure exactly when that will be. It might be 2026, it might be 2027. Because I think part of it is, again, kind of goes back to the transaction activity, the distributions, people feeling comfortable about price discovery, et cetera. But, there's still pockets of capital out there, and the U.S. is still considered to be the best place to invest. So by and large, we're getting the greatest allocation. But if you kind of break it down a little bit, and I'll start first with, the U.S. market,
Yep.
Pension plans, very mature real estate portfolios. So you're really trying to find the right inflection point where the timing works, that they're maybe expanding, maybe they're looking to replace managers, maybe they're changing their allocation mix slightly, but you need to figure out how you complement their existing portfolio. And that really goes to the same with Canada, but I would say with the Canadian investors, a lot of them over the past several years, especially the larger ones, are going on a more direct basis. And then, you kind of work across the globe. In Europe, again, another very mature market. But during the global financial crisis, they had some regulatory changes, and so they have some leverage covenants. So they've been traditionally more core plus oriented investors rather than value-add opportunistic. Keep going. Asia's a big market, obviously. I'll come back to the Middle East because we'll end on a positive note there. But as it relates to Asia, it's very much nuanced. Let's just say China, you had some very large sovereign wealth funds that were big investors and loyal investors, but obviously given the political environment, we'll see. It's kind of a wait and see there. Korea and Japan, I'll kind of put them both in one bucket right now, just in the sense that they do have some regulatory, it depends on who you're marketing to. So a lot of times you have to register a fund, you have to have a local AMC. They've been traditionally core plus buyers, but with hedging costs, they're kind of coming up the risk curve because they have to. And I would say that they have fairly young portfolios, not across the board, but I'd say generally speaking, so there's appetite there. Australia, New Zealand, best of luck. They're going to try to push on fees. They want to work on direct SMAs. So that is challenging as a GP that manages commingled funds. And then the Middle East. The Middle East, obviously, their money comes out of the ground, so they're very fortunate. They continue to grow, but they are a sophisticated group, and they will grind you on structure and fees. And I think that over the past couple of years, kind of going back to your question as well of what we're hearing, is liquidity, transaction volume has been down, so money hasn't been put to work. So yes, it's sitting on the sidelines, but a lot of it is still being charged a full commitment fee, and so the J-curve effect is real. And so you are hearing, how can we mitigate this? And that's really pushing on fees and structure.
Julia, anything you want to add to that?
No, Jen covered it well. Obviously in Korea, you've got a lot of people who still have direct investments in the U.S. that they haven't gotten back. So I think it will be more muted this year on the fundraising front, but that doesn't mean that it won't be a good investing year. In fact, I think that will lead to hopefully better flows in the future.
Yeah, I think one of the things that we see when we deal with LPs is, again, they just constantly come back to records amount of dry powder, slow pace of distributions, and it just puts a damper on any new investments that they want to make. A couple other things that just to piggyback on your comments, Jen, you know, the Middle East, I think never before has there been a growth in wealth managers out of the Middle East that are now investing in the U.S. You know, I didn't think that that really existed, you know, more than three or 4 years ago. And the other thing to keep in mind, you know, just given where we are with inflation and potentially tariffs, you know, that will ripple through the currency markets. And then obviously a lot of the investors will index up or down their investment style just based on wherever the hedging costs are. Maybe we'll spend a little time just on what sponsors are doing to help augment fundraising, right? So last 2 years, incredibly hard. So what are some of the strategies that asset managers are doing to try and lure in LPs?
Even though my day job is Chief Investment Officer at LoanCore, which is our debt division, I also sit on the executive committee of Divco West, which is our equity fund manager. And Divco is on to their 7th fund. They're a little different. They have a lot of investors. We have 2 investors at LoanCore, large investors. And what Divco's doing is, first of all, the things they already own, you know, like intense management. The amount you have to work for relative to how well you get paid today is not, you know, it's not a good ratio. And that's just true of everyone. But offering to provide services, especially to banks who have a real predicament with other sponsors and maybe other borrowers who are out of money, and offering to work for, we'll call it cost plus, borrow a construction phrase, to basically help people through their problems to gain trust and deal flow opportunity. That's one thing we're doing, not necessarily to gain LPs, but to promote the business in an otherwise relatively stagnated market.
Jen, anything you would add to that?
Yeah, I mean, I think one, you're never going to convince an investor to invest with you just because you're offering better fees. I think that it comes to more than that. But with that said, obviously, if you have someone that's on the fence, it's a mover. But it also is impactful with your existing investors, especially those that have been loyal, maybe those that are going through some turbulence right now with your own portfolios. So I do think fee discounts are important and are becoming more and more prevalent. You know, you hear about and GP stakes, promote discounts. You know, I think that some of the larger investors are more focused on SMAs because it's a better economic structure for them and better governance. But it's challenging. I think at the end of the day, though, from building relationships, these partnerships are long. I mean, you think about a fund life, a traditional fund life is 10 years, and it can even go beyond that. So I think at the end of the day, it really comes down to trust and transparency and the level of communication. And the other boxes being track record and team and stuff need to be checked, but I think that's kind of key. So fees are definitely important. J-curve is definitely important. Those can be structured through some economic incentives, but at the end of the day, it's the other things that matter too.
Yeah, 2 things kind of stand out to me just based on our fundraising business. One, intense interest in revenue shares. You know, I think going back maybe 10 years ago, there was more interest in GP stakes from some of the pensions. Feels like that's a little bit more muted. There are some, but certainly much more interest. And even some of the U.S. pensions have gotten pretty progressive when they're working with sponsors to launch new products and maybe participating in a revenue share that may be simpler for them to understand. And if they're going to help augment or raise a new product, perhaps get a fee discount, you know, as the vehicle scales. And then the other, and we'll touch on this later, is any way you can create scalable co-invest. And so we've been involved in situations where we've represented clients on the buy side, whether it's involved a take private, buying assets out of REITs, et cetera. And that creates a lot of interest from the larger investors. And that has certainly translated into ultimate fund investments.
Yeah, I'll just comment on co-investments, although I maybe we're getting to it later.
Yeah.
But co-investments definitely is a key thing, and it helps the larger investors blend down, but it is also still amazing that there's still a number of investors that don't have the manpower or the skill set to make quick decisions. So it's something that you have to focus on within your documents.
Yeah. Well, maybe before we leave this topic, I mean, there are kind of two things that stand out. I think one, again, from the investors, it just feels like they don't totally have conviction on where real estate's going, and obviously that will kind of mute some of their interest in doing real estate, and you see that less with the larger public pension funds that have direct allocations to real estate. You see that typically with 10 billion or less AUM investors where there's one privates professional. But I think the other thing that sort of at least concerned me coming into the year, and maybe I'm less concerned about it, I don't know, Tim and Julia can let me know, was just the debt availability, right? I mean, there's $7 trillion of commercial real estate debt that's outstanding. Half of that comes due by 27. Most of that is owned by small or super regional banks. And so given the proximity of debt to new acquisitions, most of those are going to be sales of existing assets. Like, is there enough debt availability to actually capitalize the market in terms of what needs to be sold?
Look, I think it depends on the product, right? If you have high quality, good real estate, good sponsorship, there's endless capital right now, like 15 bids for same, kind of credit. Even on the office side, on the high quality office side, we've seen interest come back, which has been really interesting this year. I mean, there was like zero interest 2 years ago in office. But if you have older vintage, low, yielding assets, it's more challenging. And I think that's where you're going to have more forced selling and transfers. In Tim's words, you'll have more lenders become owners. Which is natural and happens and healthy, but I just feel in the spot moment, there's a lot of liquidity and a lot of availability of capital. That might be a Q1 phenomenon because it generally is more exuberant at this time of year coming out of some of the conferences. But values are stabilizing, and that is going to give lenders confidence. And you certainly have had a lot of banks work with their borrowers and I think they all learned from the GFC, like they didn't have to put up the total amount to pay down the loan to meet a maturity. Like if you did a 5 to 8% pay down, you were going to get a couple years of extension. And so you naturally have less of this wall of maturities that everyone's talking about, I think has been more talk than actual, issue.
Yeah, I agree. It's two different topics. The wall of maturities hasn't really materialized, and sure, some of the banks and regional banks are suffering. There's tons of debt available. It's intensely competitive in my business. It's because what you saw, those spreads have tightened, and everyone sees that and cues off of that and lowers their spread to the borrowers. And even for office, and just to put some characterization on that, we generally lend between 30 and 130 million bucks. So we're mid-market. We're not huge lenders. Mark Halliday put up a screen with a bunch of SASB office deals that went off in the last year and a half. And that's a good sign, but those are great, well-heeled sponsors usually. I might deal with more of a normal cut of people across the United States. And it's tough to get an office loan in that size range in most instances, but I can see that coming back too, and I say that because I just went on the road and sold $1.1 billion of bonds, and I had the people buying my bonds ask me, can you please bring us some good office because we're underallocated in office now as a result of nothing showing up for 2.5 years. But it's going to be, we're going to pick our spots very carefully, and we're going to charge a lot for it because that's what it's necessary. But I think in general, there's tons of debt capital in the United States for real estate.
So it doesn't sound like for either of you it concerns you.
I just want more transactions so it's not so competitive.
Yeah. Well, if you could refer some of the people that are interested in office to me, that would be really helpful. Maybe we'll skip to one more slide. This is not this one. All right, this slide. So I think over the last, this is just a chart that shows the largest REITs, 2014 largest REITs today. You can see the change and certainly the tech influence among the largest REITs. And also what's not on there is the broader alternative sectors. So anything that's not traditional resi, office, retail, industrial, we just tend to refer to as niche sector investing. You know, the public market today is probably 60-ish% now, non-traditional. I think the average private investor, at least from what we see, and there are obviously some exceptions to this, are sub 20%. And so I guess, you know, a leading question just would be, do we expect to see a continued rotation into non-traditional in the private market that's going to filter through and hopefully try to catch up to where the listed market is?
So I'll start with that. I think the short answer is yes, but I do think that, you know, one, if you think about like the Odyssey funds, the largest component of Odyssey funds used to be office, and now obviously people are hesitant. They've tried to move away from office over the past couple of years, and so it's like, well, where do they put that capital? And so I think a lot of groups are trying to, again, find gaps in their portfolio and complement their existing portfolio. So there has been this mad dash to try to find these more niche strategies. You know, obviously data centers is a big component of that. Takes a lot of capital, but the story hasn't played out. But you hear about marinas and convenience stores, and, you know, I mean, real estate has really expanded as it relates to true alternatives. So I think that there's a lot of growth that can be done, but I do think that the primary food groups will still capture the majority because people understand them. You can underwrite the demand side, you see the supply side, where the other stuff, there's a lot of gray associated with those decision makers.
And Julia, for you, like what's driving investor demand in these non-traditional sectors?
Well, if you look at on one of your prior slides, the capital formation that's happened over the past few years, it's been more value add opportunistic, much less core capital. And so to get those returns, you have to go generally up take on more risk, or you're going to go into less liquid asset types. So I think that's certainly one of the reasons, but obviously you're seeing a convergence between real estate and infrastructure now. And I think just on the digital side, the demand for power and obviously data centers is real. So that's obviously driving a lot of this change right now, if you just look at the data centers. And then obviously there's companies like Welltower that are phenomenal at raising capital and talking about the tailwinds in their sectors and their growth. So there's a lot of different reasons. I do agree with Jen that our main sectors are still going to have great returns and they have great fundamentals right now. And so as there's more time and as people see that values have truly stabilized, I think the capital will come back into those sectors because you're going to be able to earn great, maybe value, not opportunistic, but core plus value add returns in those sectors again.
Yeah, I think originally because a lot of this all started in 15, 16, first with senior housing and then moving into self-storage. I think a lot of the investors looked at the sectors and said, they're fragmented. There's the ability to kind of roll up individual assets. And then once you create the platform, maybe that creates a competitive moat for yourself that maybe would be, stronger than you might have in other sectors.
Sure.
Maybe that's true, maybe it's not. But I think it just comes down to in the prior market where cap rates were so low for multifamily and industrial, people were just desperate to buy anything that was a little bit wider and maybe had more perhaps growth or defensive characteristics.
I think one other thing that just to build on that though, thinking about industrial, for example, at one point it was just industrial. Now it's cold storage, it's triple net lease, it's,
manufacturing.
Exactly. So it's expanded it's created multiple categories. So when you drill down to it, and you can say the same thing for multifamily, we look at it as for rent residential. it could be multifamily apartments, it could be garden style, mid-rise, high-rise, but at the same time you have student, you have senior, you have SFR, BTR. So they suddenly are taking these primary asset classes and they've splintered them into multiple more niche strategies.
Good marketing.
Yes.
It's all storytelling, Jarrett.
At the end of the
Correct.
day, yes, you have to have a story.
Correct. Well, maybe let's move to the next topic, and I'm just mindful of the clock because we're going to save some time at the end for questions. And one of the big themes the last couple of years has just been manager consolidation. And I'm not talking about LPs reducing the number of managers. I'm talking about change of control deals, sponsors buying other sponsors. And yes, there is consolidation of capital where the largest asset managers are getting a bigger share of LP wallet, at least as it relates to real estate. And so, Julia, Jen, like what's driving the consolidation at the asset manager level first?
Look, I think when I started investing in real estate, which was a long time ago, you had a lot of fragmented regional specialists, and now it's all about size and scale. And that scale gives you relevance in the marketplace. It gives you, and what I mean by relevance is when you want to go buy a bigger portfolio or anything really, you are either lending to them, buying from them, et cetera, selling to them. And so you have that relationship where you can help each other and you can get better off-market or first and last looks. And so that's driven a lot of the consolidation, is just how do you amass that scale and grow more quickly. And I think that's also part of bigger investment managers' mandates. Just, it's more about fee-paying AUM and less about promotes. And so that's another reason. But obviously, there are GPs that want to sell too, and they've been around a long time, and they have estate planning or they have succession planning, and so they're ready to do their next step. So there's, been a harmony there.
I'm going to chime in, even though you didn't say my name. The level of sophistication among commercial real estate investors is light years ahead of where it was when I started my career. You think back of the S&L crisis. Some of the companies you know really well now were born out of the S&L crisis. It was, you drove a rental car to some building and you got a file that was half empty and that was your diligence. I mean, now it's absurd. The data rooms, you know everything, and the people you're competing against to buy are very smart and well-educated. Places like Columbia Business School educates these hardworking, bright people, and that's what the industry's become, and that's what the LPs demand. And so one of the ways you can rise to that occasion is you get scale, because without scale, you can't make quick decisions and with knowledge. That's my 2 cents.
Yeah, I mean, I think just trying to take the angle from the fundraising side, if you're overseas and they're going to committee, they want to make sure that they're going in with a name that's been heard of. And so obviously that as a result is some of the larger fund managers out there. Teams are small, so they also are looking to do more with fewer. So that drives some of this. There'll be winners and losers. I will say it still amazes me, though, how many new managers are launching new funds. I mean, there was an article recently that referenced, I think there were 27 funds that were launched. This was real assets, the majority of which include real estate, but 27 funds were launched in January alone. 12 of those were new entrants. And I'm like, that's a major stat. So I do think when there's times of dislocation, we saw the same thing with GFC. There will be a lot of new firms that will develop, be formed, but at the same time, I do think the market is primed for some consolidation.
Yeah, I think there's a couple of factors at play. I think number one, real estate private equity came into existence in the early to mid 2000s, so it's not surprising that some of the founders there are thinking about, what they're going to do next. I think the other is with the advent of listed alternatives managers. One, they provided a blueprint for how you go public, which is you need to be a large, diversified alt manager with all the products covered. And then I think number two, they're, as a public entity, they're charged with growth, right? And so if you want to deliver 10 to 15% NFRE growth every year, that's going to lead you to consolidate other managers. And then I think, Jennifer, you're 100% right. I mean, the last 10 years from a capital raising perspective has been sector, 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 almost to a T. And I think coming out of this environment where it's not totally obvious, like what sectors are going to grow or not, or provide above average growth rates. So I think investors have gotten more comfortable saying, you know what, I'm going to go invest with somebody that's really smart, really nimble, and given we're not going to see wholesale distress, Tim, like attack these idiosyncratic opportunities where they can take advantage of effectively a broken balance sheet, a developer that needs to sell, or any one of those situations. Maybe we'll move on, because I do want to save time at the end for the demographics and the wealth concentration, because to me that's the most interesting. And maybe we'll just spend a few minutes just on new products, because I do think you're seeing a proliferation of non-traded REITs, registered investment companies. The open-end core fund market is stratifying pretty quickly, and then something that's near and dear to me, continuation funds. And so maybe Julia or Jen, maybe I'll have you start off.
You want to start? Sure. So yeah, I run one of these 40 Act REITs that's geared towards the private wealth audience, and I've only been doing this about 2 years, so it's been a real learning curve for me, but super interesting. And obviously, real estate's been out of favor. The sentiment hasn't been great in the private wealth universe just because of all the negative headlines. But and I know you're going to talk about demographics, Jarrett, in terms of where all the private wealth is concentrated. But if you look at these RICs and NTRs, and now all these large core evergreen funds, which are not just in real estate, they're now spanning, we have 4 major products. We've got a real estate, infrastructure, private credit, and a private equity fund, and we call them the K series. But if you look at the amount of private wealth that is invested in these kind of open, they're privately registered, but they're open to people who have $10,000 or more. There's very little of that capital in these private funds. So they're predominantly invested in public markets, and yet their wealth is growing. And so I think it's about 3% was the last stat I saw out of I think it's like an $800 billion market in the US. So there's a lot of money that could come into these vehicles, and which is why you're seeing more capital formation and more of these funds coming out. And I think it serves a great purpose, right? Having access to institutional quality, high quality real estate. A lot of people own their homes, but they can't access high quality assets in Japan or even New York City. And so if they can buy a piece of that through one of these private but open-ended vehicles, it's a great value to them. So that's why they're proliferating. It's we've suddenly realized we're not serving a huge pocket of wealth, but I do think it'll come back into favor as the headlines become more positive, and that'll be a bigger avenue going forward for capital formation.
Yeah, and I think I'll just add, new products are developed in order to either attract a new investor pool, which high net worth is becoming a bigger and bigger focus, or tax mitigation. Trying to make something more efficient, and real estate in itself with capital gains, with depreciation, offsetting income and stuff like that, it is a tax efficient vehicle for a number of investors. So I think that if you think the PE side, PE has tapped that market, the RIAs, the wirehouses, et cetera. And real estate is, I won't say just getting started because it's been happening, but still has room to grow.
Yeah, and it's tax efficient income, which as we talk about who has all of this capital, like the older demographics want more income.
Right. And as it relates to the Odyssey fund market or core products, some of these funds have been around since the 70s. And so they just have been positioned as large, diversified funds. And what I think is happening in the open end or core plus market is that it's effectively stratifying, just like what you've seen in REIT world. It wasn't that long ago you had such a thing as a diversified REIT. That doesn't exist anymore, certainly not in scale. And so if you evaluate all of the new product launches in the open-end core market, almost all of them have been sector-focused. There's a couple that do healthcare. There's one that's being launched that's going to be in digital. You've got ones that cover other asset classes. And so I would expect that to continue. And then maybe just the last point on the continuation funds, just because that market has grown incredibly within private equity, real estate's not far behind. That market last year was $140 billion, the secondary market globally. About $80 billion of that was GP-led transactions. And that doesn't even cover asset level recaps for real estate, which is probably another 20 or 30 billion. So I think from our vantage point, particularly for the larger, more sophisticated investors, they are very attracted to these large, scalable, thematic opportunities where they can invest in scale and basically control a platform with one of their best sponsors. So I would imagine we're going to continue to see more of that kind of going forward. And maybe one last slide. We've been talking about demographics and wealth for a little bit. See if I can go back. All right, so this is and this for sure is going to make Tim happy. I'm positive. Okay. But if you evaluate the demographics of the U.S., right, so baby boomers, they are no longer the largest age cohort. They're behind the millennials, and the millennials are having babies, which is a good thing. But all of the wealth, almost 70+% of the wealth in the U.S. is concentrated in baby boomers or older. And so what they're doing right now is transitioning out of equities, right? If you remember the normal kind of portfolio management guidance, you would have been 70% equities, 30% fixed income. That is now all rapidly reversing. And so I think, one, I would imagine you would all agree, but it's going to force transition into fixed income related products. And I think there's going to be a massive premium for core and core plus real estate because of the income potential, both short and long duration. And so maybe, I don't know, Julia, if you could just comment on that at all.
Well, it's certainly, how we're selling things, I would say. I'm not sure it's, totally true yet, but from a sales standpoint, like Jen was saying, the tax efficiency of real estate, the income that you get, the fact that generally real estate outperforms inflation, and we think we're in a higher for longer inflationary market. There's a lot of reason to believe that real estate satisfies a big need for people's portfolios. So I think we're all hopeful that this is going to lead to more flows. But I do think the storyline has been harder just given the fear. There's been a lot of fear. I think we were getting questions even into late last year, which was surprising to me, about like the contagion effect of office. And like, it's not happening, but there's still questions about that.
Any final comments, Tim?
Well, you made me positive. It was amazing. I loved what you did there. So I am positive about debt investment. Prior to my role with LoanCore and Divco West, I oversaw U.S. real estate, which included debt, equity, high yield for a multi-strategy hedge fund. And so I've got some experience picking and choosing, where do I want to put money to work? And I think the next 5, maybe 10 years could be the most interesting for debt in my career, maybe going back 40, 50 years, because the safety of the debt that we're writing now, I think, is better than any time I can remember. We can use CMBS as a proxy, although CMBS is just part of the market. Conduit debt yields were about 13 the last couple of years, NOI divided by the loan amount. And in past periods, that was closer to 10 or 10.5. And so obviously it's driven by rates and views on cap rates. But as a lender, you just have that much more comfort. Because rates are where they are, we could return what I think are pretty good doubles or low teens returns to investors for structured finance positions in debt without taking equity risk. Don't get me wrong, equity is more sexy. You can have much more upside with equity. But I happen to think the next 5 to 10 years will be interesting for debt.
Jen, anything you want to add?
I just, we are an equity shop, so I would say that we're in an environment right now that you could have some incredible buys, and so you'd hate to cap your upside. So it really depends on who's making the decision and what their ultimate risk-return focus is and strategy. But I would say that both of them are attractive for different reasons. Debt, obviously there's a nice current income, but equity in the sense of taking advantage of the dislocation and the upside opportunity is significant.
Great, thank you. So I think we're going to pause here and take some questions if there are any. I'm not sure who has got the microphone. Oh, there you go.
We said it all.
Yeah.
I guess
Very
so.
thorough.
It was amazing.
We're-
Thanks for the panel. This question is for Julia. I'm curious about KKR's strategy and your group's strategy based on changes and potential changes in public policy that are predicted from DC related to HUD, Fannie, Freddie, FHFA, and other organizations, or whether you guys are maybe kind of wait and see approach for what you guys are going to be doing for your investment vehicles. Thanks.
Yeah, I mean, I feel pretty lucky. We have a broad and nimble investment mandate, so we can invest across the capital structure. So when we feel like we're making equity-like returns in credit, we're going to do more credit, and when credit becomes more commoditized, we flip back into equity. But in terms of regulation, obviously, we're always looking at the regulatory environment and in even state and local level regulatory risk. When you talk about housing, I think we're trying to be careful in terms of where we invest in general. And I think housing is well primed to do well over the next few years, just because we're underhoused still and it's still unaffordable for many people to buy a home. So I think we're going to focus more on multifamily, less on SFR for some of the reasons you bring up, and be really micro in terms of the locations. I think we're entering a market where asset selection and market selection is more important again. We came out of a period where you could, throw a dart on the board and everyone was doing well, just because there had been so much cap rate compression. So certainly looking at regulation, but it's not from a, I think, federal level as big of a concern for us right in the spot moment. I'm kind of curious. Maybe we could take a, poll or like show of hands. I'd like to know what you all think about the year ahead. Is everyone positive on 25? Is this a thrive in 25? Raise your hand if you're thrive in 25. Okay, and how many are survive this year?
Yeah.
Okay. It's going to be an interesting year.
Investing in real estate, someone said this a long time ago, and it stuck with me. Investing in real estate is placing bets on where people choose to live, play, and work, which is pretty cool when you think about it that way. It's tangible, right? It's not just a Bloomberg screen. But I've never have I been more surprised at how rapidly things are changing. You get to a point in your career you think you've seen it all. And to the question, to your answer, stroke of pen risk with government policy, I don't remember it ever being such a huge driver, and it is a driver, and that's another reason you have to have scale and nimble mandates, because you have to ebb and flow with these things. But there's a lot of instability out there. I'm not saying that's bad, that's not negative, it's just a reality.
Yeah, certainly happy we don't own any GSA leases.
Yeah.
Although they pulled that back yesterday.
Yeah, just on that point on instability, if you just look at this chart right here, this just tracks the massive underperformance of real estate against the broader market. But what I think is more interesting is if you look at it versus an equal weighted S&P 500 versus market weighted. and how dramatic the difference is, right? Because you've essentially got 7 stocks that are now close to 30% of the S&P 500. They're all tech stocks. And clearly, a lot can hinge on that and drive dramatic market movements. And then, if you're a relative value investor, you'd like to think that this can't continue forever in terms of real estate's underperformance, especially if we're going to be in an environment that is inflation heavy and there's a need for hard assets.
And supply stays muted.
Absolutely.
Fortunately, we have real estate professionals in the room versus investors in the room because this can be depressing.
It can be. Just means it's a good time to buy.
Yes.
Any other questions?
Hi, my question's for Jennifer. Could you talk about LP interest for like tech real estate and how has that been different from traditional real estate?
Like prop tech?
Yeah, also data center real estate and anything hardcore that has a technology angle to it, cell towers.
So it's interesting because obviously they're not brand new, but they're relatively new property types. So starting with like data centers, we actually do see some allocation through the infrastructure versus some allocation through real estate, some of it's special situations. I think there's some groups are still trying to figure out, some of them are working together, just ultimately, like it depends on the actual structure, it depends on the lease terms, et cetera. Prop tech is probably still a very small percentage overall of portfolios, but I do think that there are certain groups, probably the larger groups, that have some interest in learning more because everyone understands the competitive edge on advancing some of the digital technology. So I do think that there's appetite there. It's just unknown, right? I mean, you're sitting down and you're hearing about an idea, but you don't know exactly the direction that it's going to go into. I mean, technology moves very quickly. So I think that's part of the whole thing. Like we do know that the need for power and the need for data is important. It's going to continue to grow. But at the same time, I remember having a BlackBerry and I remember having, a phone with a cord. Now everything's getting smaller, everything's getting faster, and so that's going to be an impact.
Yeah, I think prop tech went through a moment where it was incredibly popular, and I'm not sure the performance has been all there, maybe a bit limited. And then as it relates to the digital crossover, I mean, really it's narrowed between data centers, towers, and fiber. Mm-hmm. And all the interest today, or I shouldn't say all, a lot of the interest today is indexed on hyperscale. So if we have a PropCo deal or we have a platform that you can raise money into, there is a lot of interest. Conversely, there's a ton of platforms that need capital, right? And we've gone from a world where, doing a 24 megawatt data center was a big deal, and now people are talking about gig farms that cost $20 billion. So that's a significant amount of capital that will be, required.
And Jarrett, do you see a lot of transaction volume, though, in the sense of realizations in that space, or it's just?
No. We see a lot of transactions for development projects. So the moment somebody has powered land, they have a lease, all of that seems infinitely financeable and be able to be capitalized. The challenge has really just been everything around the yield curves. So once it's stabilized, you've got a 20-year lease. And some of that is just driven by the investor sentiment. Nobody wants to go long duration in a market where interest rate volatility is going to persist. And so placing a bet that I want to own something at a 6 or 6.5 cap rate for 20 years, we've seen less interest in that. This market feels more like value-oriented and a little bit growth-oriented. So find me things that can give me a little bit of growth, but maybe not totally far out on the spectrum in some of the risk that was in the market before 22. Great. Well, thank you, everybody.